Financial Accounting, Chapter 5, Narrated PowerPoint. Accounting for Merchandising Businesses, Slide 1 of 3. This chapter is going to be broken up into 3 videos, and Objective 2 is a tough one, so we're going to break it out into a separate video for conclusion because there's lots of new terms, lots of new ideas, and everything is building on a clear and strong understanding of chapters 1 through 4. So when we do chapter 5, we assume that everyone is clear about the debit and credit rules in a general sense. I mean, it still takes a bit of time to stop and think, okay, assets are increased with a debit, liabilities and stockholders' equity are increased with a credit. That type of hesitation is natural, but students have to understand what the rules of debit and credit are for. They need to understand how journal entries look and what the purpose is to record a transaction, and how these journal entries are posted to ledgers, and how these ledgers are used to create an unadjusted trial balance, then to create adjusting entries, and then to create an adjusted trial balance, and from there you can prepare the 3 financial statements. Because a clear understanding of all of this, as well as the 3 financial statements, it's what helps us move forward as we talk about in Chapter 5, a merchandising business. So let's be clear about what a merchandising business is. This is retail. So let's move forward. Merchandising retail is a store like Walmart, it's a grocery store, it's a craft shop, it's anything that sells inventory. A service business is something such as a law firm or a doctor's office or an accounting firm, a consulting firm. Now, a lot of these are blended. So, for example, a landscaping company, for the most part, is a service business where they do people's landscaping work. They cut grass, they edge, they weed eat, but they might also sell sod, they might also sell plants, fertilizer, and they would keep all of this in inventory. When you're studying this, however, in your introductory accounting course, we're going to try to look at this as a pure, clear business. Service businesses were discussed in chapters 1, 2, 3, and 4. So chapter 5, as we anticipated, is going to build on what you learned in the first 4 chapters, and we're going to talk about the retailing world, merchandising. So Walmart is an example of a merchandiser. They sell a product. They sell goods, as it's sometimes called, inventory. They will use this in the purest term, assuming that Walmart doesn't prepare a service and assuming that Walmart doesn't manufacture any of their products, which in fact, I know they do not manufacture their products. So this is a pure merchandising company. So to understand this, we have to talk about the operating cycle. And it's the cycle that talks about how a company generates revenue and receives the cash or collects the accounts receivable, uses that to go back in and purchase inventory, and then starts the cycle all over again as far as selling their inventory. So the operating cycle is complicated whenever you get into a company that has inventory. So just a quick illustration, a company that maybe, let's say that a person decides to open up a small store and they want to have their biggest sales occur at the holiday time, at the winter, Christmas, or whatever. And so this company knows they're going to have to stock their store with inventory. Frequently, they'll go do their purchasing in the fall and hopefully have their inventory stocked by November. And let's say it's a toy store. For the most part, their sales will be cash, but if they allow their customers to charge it, not credit card, but charge it, then they might have some credit sales, which would include accounts receivable. And the time it takes for them to purchase the inventory, sell it, and collect the accounts receivable is known as the operating cycle. Here's an illustration. So let me get my pointer together. Sorry, having a little bit of technical difficulties sometimes as I use this. Here we go. So the idea is that you take the cash that the company has and you buy merchandise, which means you buy inventory. And that inventory comes into your store and you sell it. And your customers buy it from you. And they probably will charge it in a lot of companies. By charging it, I mean in accounts receivable. And then the business will collect the money, take the cash, and buy more merchandise. And this is the cycle. Probably the very best example of this is a textbook in a bookstore, for example, like the Citadel. So the Citadel's textbooks are purchased and shipped to the Citadel bookstore and sold to students. And many times students... Okay, the operating cycle can differ depending on the type of business. And we've got some really good illustrations here. Grocery stores have short operating cycles, and they're going to make their sales within a week or two, similarly for a produce company. But a jewelry store or a car dealership is going to have a long operating cycle. And this is sort of an intro for students in introductory business, introductory accounting, because a lot of students aren't familiar with the way that businesses have to work. Oftentimes, if that cycle doesn't result in cash quickly enough, they may have to borrow money to meet their cash needs, to pay their employees, or to buy more inventory so that the cycle can start again. This is a big key to understanding the accounting for a merchandising business. So let's look at a service business, which we just learned about, where we have revenues, expenses, and income. And I taught you with a very simple example, and that was sales or fees earned minus expenses equals operating income or net income. So this is a service business, a lot less complicated. Okay, let's go to a merchandising or retail business. There's a new account here, and this is where students need to have a pencil and paper with them whenever they listen to these videos or when they study the book, because this new term is an important one and students need to be familiar with it, because we're going to build on it as we start to learn how cost of goods sold is calculated. So let's first look at the entire cycle in the way that it goes. And that is this. We've got a merchandising business. We look at sales. We've got something called cost of goods sold right here. And from there, we have this new term called gross profit. I need you to write that down as a familiar expense. And then we have more operating expenses in our operating income. So let's take a minute and talk about cost of goods sold. It is what it says it is. It's the cost of the goods that are sold, the cost of the inventory, the cost of the merchandise that is sold in a retail store. It's the cost of the inventory sold. Notice all those terms are used interchangeably. That's a good thing to take notes about. Goods, inventory, merchandise, those are all the same thing. It's the cost of the stuff that the business is selling. Cost means expense. Very important. Cost of goods sold is an expense. And it is subtracted. Notice the parentheses around the X's that delineate that it's a number. So it is subtracted. It's subtracted. This is a subtraction. So take your revenue, your sales, subtract out the cost of the goods that are sold, and then here's another big one to write down. Gross profit. Gross profit is not an account. It's a subtotal. Let me say that again. It's been misunderstood by hundreds of students. Cost of goods sold is an expense. Gross profit is a subtotal. It's sort of like, whoa, let's stop, time out. What's the profit that we make off of the goods that we sell before we pay our operating expenses? Again, what's the profit off of the goods that we sell before we pay our operating expenses? So let's say that a t-shirt manufacturer sells their t-shirts for $20, and those t-shirts cost $8. Then the gross profit would be $12. Sale is 20, cost of goods sold is 8. That's what the store paid for the t-shirt that they sold. Gross profit is 12. Now they've got other expenses to pay. They have rent, wages, insurance, taxes. There's just so many other expenses that need to be paid to help to make income within this company. So always remember that if you go to a store, and that is that whenever you go make a purchase, that store may not have had to have paid too much for that product, but they've got lots of operating expenses. And I have to add, that's what's happening if we want to take a quick pause to discuss what goes on in the business world. And that is that operating expenses for a store Now, let's talk about these financial statements where merchandise is considered to be a sale, and we subtract out cost of goods sold, and that's going to equal one of two things. It's sometimes called gross margin, sometimes it's called gross profit. Now, gross means before other expenses have been subtracted out. So, for example, your gross paycheck, for those of you that are employed, is larger than your net paycheck when they've taken taxes and insurance out of your pay. So gross means that we've got a subtotal in here and we've got something else to subtract. So you should stop and remember the prior slide. There are operating expenses to be subtracted from gross margin or gross profit. Sometimes it's called margins. In the business world, you'll hear individuals say, what was your margin off of that job? And that means how much did you get before having to pay other expenses purely off of that job? So for the t-shirt, the margin is $12. If a t-shirt sells for $20 and costs $8, then the margin is $12. Write these terms down. Make sure that you remember them. Sales, cost of goods sold, also called COGS sometimes, and gross profit. Okay, merchandise on hand that hasn't been sold is called inventory or merchandise inventory, and it is a current asset on the balance sheet. If you were to pause this video and look for if you look for Walmart and you go to their balance sheet and you look in the current assets, it's between $30 and $40 billion worth of inventory on their shelves at the end of the year on January 31st. Huge amounts. That means that for every Walmart store in the world and Sam's, they've added up how much inventory was sitting on the shelves on hand, not sold. About $30 to $40 billion. It varies from year to year. Again, current asset. One of those things you have to remember as we move forward. Okay, let's continue to expand as we do in financial accounting, slide to slide, chapter to chapter. Merchandising transactions. Now that we know that sales minus cost of goods sold equals gross margin or gross profit, those two terms mean the same thing, we're going to find that the transactions are recorded with the exact same debit and credit rules we've been using. Inventory as a current asset is increased with a debit. Cost of goods sold as a current asset is increased with a debit. But what we're going to find is that there's a lot of complications. So let's just stop a minute and just be honest. Merchandising is harder than the service industry. That's why we learned our financial accounting first through the service industry, and now we're moving into more complicated areas. So we're going to start with the new term called subsidiary ledgers. And a subsidiary ledger is a separate ledger aside from the general ledger where we will record individual transactions. So there'll be a sales ledger, there might be an inventory ledger, there might be an assets ledger, but there's always going to be a primary ledger, and that primary ledger is going to be called the general ledger, as we talked about in prior chapters. So the general ledger is what we're used to seeing, but now we're going to introduce the concept of a subsidiary ledger. And each subsidiary ledger has an account in the general ledger that is their controlling account. So here's the way I like to think about it. I have, for example, on my desktop, I have a file that says BADM 211. And when I open that file, that's my controlling file. When I open that file, there are dozens of subsidiary files, sub-files. There's a sub-file for different years. There's a sub-file for different chapters in my BADM 211 course. So that's the same concept. The general ledger, common subsidiary ledgers. There's going to be one for accounts receivable, sometimes known as the customer ledger. And people that work in receivables in a company will deal exclusively with the accounts receivable subsidiary ledger. There's going to be an accounts payable subsidiary ledger, sometimes called the creditor's ledger. And it's going to show all the bills that the company owes. And then you're going to have an inventory ledger that's going to have a subsidiary ledger that's going to show all the specific items. So you can imagine that an accounts receivable subsidiary ledger will show all the different customers and how much they owe them. The Citadel will have one for each student. Whenever students don't pay their tuition but instead pay it over time, the Citadel will have accounts receivable subsidiary ledger. Accounts payable subsidiary ledger is going to show all the bills that are owed. Those are the creditors. So for example, if we're talking about Walmart as a retail store, Walmart might have a specific creditors list for Fruit of the Loom or for Procter & Gamble or for whatever vendors they use. And then finally, inventory. Let's think about Walmart. Wow, they probably have lawn and garden. They probably have food. They probably have one for adult beverages. They probably have one for children's toys, for shoes. And there's probably a manager in charge of each one of these subsidiary ledgers. Many of these companies also will use special journals. And these are journals that are exclusively recording purchases, sales, and inventory reports. So the Citadel, for example, has a payables area on the second floor of Bond Hall. As you enter the building, it's to the right. And those individuals work with the payables journals, these special journals. And there are lots of accounts payable clerks in there, and they all work in the payables area. And they're the ones that are responsible for special journals to generate the accounting records. So let's talk about purchase transactions, because this has some options. So now we're going to start getting into some of the concepts in accounting that show that accounting is not 100% black and white. As we've said before, when we hit chapter 4, actually some in chapter 3, 4, and beyond, we're going beyond what an intro, bookkeeping, high school level, maybe technical school level, first accounting class would do. Technical school levels usually teach this, or community colleges usually teach this as accounting, financial accounting 2. So we're moving beyond. So let's talk about purchasing and purchase transactions. What we're dealing with is inventory. And the question is, how do we keep track of our inventory, our merchandise inventory? And we have two choices. One is perpetual and one is periodic. So first, for the perpetual one, the first thing I like to explain to students is that a perpetual inventory system is one that has every transaction recorded and updated sale by sale. And that's generally your barcoded system. So let me give you an easy example. If you were to go into a retail store where they have a barcode, whether it's a grocery store, Walmart, Walgreens, CVS, it doesn't matter where you go. And you walk in and the cashier, or maybe you go to self-service, you scan the barcode and it automatically shows on the computer what you've purchased. That is a perpetual system. It's automatically recording the sale, and it's automatically alerting the accounting system that something is missing from inventory and has been sold. And it's a little tricky, but what's happening is it's recording the cost of goods sold. It's reducing the asset called inventory, and it's increasing the expense called cost of goods sold. So under a perpetual inventory system, each purchase and sale of merchandise, every single time that barcode is scanned, it's going to perpetually record it. Now, it doesn't have to be computerized. let's just be real about this. If you go to a car dealership and buy a car, I promise you they've got a record that shows that car has been sold. They have a perpetual inventory of what's been sold on the lot. But probably if you went to a place that sells, oh gosh, let's think, mulch, and you went out to, and you took your truck and you wanted to buy a truckload of mulch to use in your yard, they probably don't keep track of how much mulch is on there. And so that moves us to the second method, and that's called the periodic inventory system method. And this one is a little dated, but there are lots of companies that use a perpetual system. That use a periodic system. So a listing on hand called a physical inventory has to be prepared at the end of the accounting period to be able to figure out cost of goods sold and the cost of inventory that's left over. So stop and think about that one for a minute. Okay, periodic inventory systems mean that there's no barcode, there's no day-to-day update on what's been sold and what is left over. It's just determined only when they say, okay, time out for adjusting entries. Let's see how much we have left, and that will tell us how much we sold. I use this example in class, and I hope it's helpful for you. So your wallet. Let's say that you have $100 in your wallet on Friday, and on Monday, you look in your wallet and you're like, oh wow, I've only got $20 left. That's an example of a periodic inventory system. You know that you spent $80, and you know that because you started with 100 and you only have 20 left. Contrast that with a perpetual inventory system. Maybe you've got something on your phone and you start with that $100 on Friday, and every time you spend money, $10 here, now you record that you've only got 90 left. You spend $20, now you record that you've only got $70 left. Maybe you go spend another $50 and now you know you've got 20 left. So you don't have to go in and see what's left in your wallet. You've backwards. Under a periodic system, cash purchases are recorded as, all right, let me back up a second. Sorry, I misspoke, and this happens as I'm recording these. I'm trying to get the highlighter to show up. There we go. Now, under a perpetual system, cash purchases are recorded straight in as inventory, and you credit cash. If you were to do a credit purchase, remember that means that you said charge it. The terms of the purchase. This is a new thought for a lot of you that have never worked in this area, and most students haven't. I've only worked in it once years ago. The terms are on an invoice. An invoice is the bill that the seller sends to the buyer. And here's what an invoice might look like. Sold to, customer order. There's something here called FOB, that means free on board. That's a term we're probably not going to talk about much. Here's the terms. 210 net 30. Notice the way I said that. 210 net 30. So this invoice comes through, and the company records that there is a sale of $3,000. Sorry, that there was a purchase of $3,000. And they'll debit inventory and they'll credit accounts payable because the invoice date is January 5th. That's the date that it's shipped. But the payment relates to these terms. So we'll talk about these terms in the next slide. Okay, the terms are called credit terms. Now, we as individuals purchasing things aren't used to credit terms. We're used to paying for cash or a credit card. But these credit terms are not credit cards. These are what terms are they extending credit to us. So there's a credit period, which means how much time do we have to pay our bill. And if we don't pay it within the credit period, oftentimes we're going to be charged a late fee and interest. So let's look at the credit terms for a company. First, Companies are sometimes given purchase discounts if they purchase early. And so buyers that make an early payment will receive a purchase discount. This is a good term for your notes, and it reduces the cost of the merchandise purchased. So in looking at discounts, here's what it's going to look like. We saw one a minute ago, 210 net 30. A seller may say, hey, I'll give you 2% off if you pay within 10 days. If you don't take the discount, you have to pay me the full amount in 30 days. So these terms, for example, 210 net 30, 2% discount paid in 10 days, the net amount is due within 30 days. And you will see these terms on invoices in the corporate world. Businesses that don't take advantage of these discounts are losing out on a really nice benefit. And I have to throw this out just for a little bit of personal financial planning. Sometimes doctor's offices, dentist's offices, let's say that you go in and you're having some dental work done and it is not insured. Maybe you're getting, maybe you know that there's going to be or let's say that there's a $600 copay. You're having a crown. I've seen this happen before in a dentist's office, and they'll say, if you pay us in cash today, cash or check, we'll give you a 5% discount. Otherwise, the full amount is going to be due in X amount of time. And if you go beyond that time, they're going to start charging you interest. So here's what it's going to look like. The cash discount, the 210 net 30, the discount is 2%. If you make the payment in 10 days, otherwise the whole amount, all of it, is going to due within 30 days. And again, we got to stop and think, if you don't pay after 30 days, they're going to start charging you interest, or they're going to also add on a late fee. So one last comment related to purchases, and this is related to a term called purchase returns and allowances. I've tried to highlight all of the new terminology in red so that you can put these in your notes. Got to stop and do a quick what research shows type of tip, and that is that research shows that if you handwrite definitions and their words, the retention is increased. I know I've said this many, many times, but it's so important that you don't just rely on listening in a classroom or listening to a video, but that instead you take notes. So let's talk about purchase returns and allowances. A buyer might ask that to receive an allowance for merchandise that is returned, or maybe a price allowance for damaged or defective merchandise. And such a thing is called a purchase return and allowance. So get used to what that term means, what all these terms mean. We've talked about credit terms, we've talked about perpetual and periodic inventory in this video, and this purchase returns and allowances is something we'll be talking about in the future. So if merchandise is returned, you'll have a purchase return. If there's an allowance given because it's defective, that's like, okay, scratch and dent sale, then you will have a purchase allowance. And all of these are terms that we'll be using as we start studying with the rest of the chapter, the new, more detailed income statement that's going to have purchase returns and allowances and purchase discounts shown. And all of this is a part of the business world, and it's meant to help management in this very complex merchandising area take control of what's happening within their business. I hope this slide's been helpful. Be conscientious of the terminology as we go through, and we'll go on to our next one. And by the way, this is a typo. There are 3. This is the end of slide 1 of 3.